Hi folks, and welcome to Who Moved the Market. Well, the market for a change is moving in a very tight range, and we'll take that with both hands, Mangalam, right? Given the crazy volatility, the up and down that we've had, flat is probably not bad.
About this time is when the decline for our market started for the last few trading sessions. So this time around, flat seems like we're sitting on top of a hill, to be very honest. That's
absolutely
how a big, today's outperformance could be called. But then again, it is weekly options expiry. There has been a bit of a relief rally across the globe. Let's see where it goes.
Oh, absolutely. Well, we're not going to speak about the overall market because you've been hearing a lot of that over the last couple of hours, I'm sure. We'll focus on one specific stock, and the one that I'm talking about is Titan. And the reason is very, very interesting. Now, Mangalam got all excited, I think, in the morning when we got that deal. So what's happened basically, if you've missed the news flow, is that ADIA, which is the Abu Dhabi Investment Authority, they have gone in and put in a huge amount of money in Lenskart. We're talking $500 million of an investment. That's not small.
$500 million for 10 point some percent stake in Post Money. That values the company at $4 billion, $4.2 billion to be precise. That's 35,000 crores. That's how much they valued Lenskart at.
That's quite phenomenal. Eye care business, $4 billion of valuations.
Yeah, and I'll give you some more numbers on that. The latest known numbers that we have of Lenskart was FY22, where they did a revenue of 1,500 crores, 1,503 odd crores, and they were loss making, so the losses were close to around 102 odd crores. This is FY22, where all things digital were doing extremely well, so their revenue growth was 66% higher. Assume that this year they've grown 30% on that as well, and they're doing 2,000 crores of sales. 34,000 crore rupees for a company that has 2,000 crores of sales makes it valued at 17 times price to sales. We still don't even know whether they make profits or not.
17 times price to sales. That's the interesting thing about a lot of these new companies that you track, right? That you value, forget the profit, profits will come. Though I don't know, I mean the path to profitability debate is a separate debate all in itself.
To be very honest, that there is no other metric to watch them. Because you can't do EV to EBITDA, there is no EBITDA, you can't do price to earnings because there are no earnings. So if the only relevant number that you have is price to sales, and that's what they've valued this company at. Now, my point is that Titan has an eye care business, which up until now everyone thought, extremely small because 90% plus
all
comes
gold,
in from
jewelry.
You have another 5-7% coming in from the watches, which remember Titan started as a watch company, and then some other segments, etc. So, in that the eye care business, everyone didn't value it. But now, if an eyewear business like Lenskart is being valued at 17 times price to sales,
$4 billion.
I thought, why not analysts look at Titan's eye care business as well? Because the first 9 months of this year, they've done 524 crores in revenue.
This is just the eye care business.
This is just the eye care business. They've done an operational profit of over 90 crores, 96 odd crores.
And so at the net level, they're not profitable, but operationally the eye care business
net level they could be profitable. We don't know. They haven't reported that. But what we know for sure is that they have guided for 40% growth in the FY23 revenue and 50% growth in the FY23 operational profit. So what that means is that, of course, this year they will be 750 odd crores. Assuming they grow to 1,000 crores the year after, and you don't use 17 times price to sales that Lenskart is getting. Use a lot more conservative, 6, 7, 8, even 10 times price to sales. This business could be worth anywhere between 6,000 to 10,000 crores. Not that it matters too much in Titan's overall 3.5 lakh crore market cap business, but from 0 to 6,000 or 10,000 crores is some value still.
And the question is, I don't know if this was already being factored in. I don't know if analysts on the street do this SOTP, some of the parts for Titan, or is it just largely valued for its, jewelry business?
This was the question that I thought of immediately as well. I messaged a bunch of analysts. None of them thought of it as an SOTP business. Everyone thought of it as, jewelry plus some value ascribed to their watches business, which was also not too much. And increasingly, after they invested in CaratLane, they were adding that as a value, to their overall model. But then again, from an eyewear business standpoint, there was no SOTP, so to say. But the fact that there is a relevant metric now, which they can compare it with, why shouldn't they do it?
And like you're saying, it's not a small business. If you're talking, growth to about 1,000 crores, and probably not something you could ignore because the rival has got this massive valuation, and it's real money. This is not notional. There's not a notional deal. It's real money that someone's put on the table.
It's real money that someone's put on the table. Secondly, the rival, even if it grows to 2,000, this guy is half of that and profitable. The rivals growing at the cost of profits. Here, there is a company which is scalable, it is growing, and it is profitable. At the same time, it has the other parts of the business, which is, of course, everyone talks about jewelry, everyone talks about watches. Now, increasingly, people are talking about their saris, fragrances, ladies' handbags, which they want to be make it into a 2,500 crore business by FY27. These are just optionalities that the street sees as, business opportunities going forward, and iCare could be one of those optionalities.
Okay, so iCare, since we're on the subject, just give us an overview of how the company is doing overall. I mean, the core business, and what are the triggers to watch? What did they say at the end of the third quarter? And if someone is interested in Titan beyond, looking at this is obviously news point. What all should they keep in mind?
For Titan, the only thing that you have to look at is the way their jewelry business is growing. Are they seeing any margins growing out there or not? Because what has happened is that, something that every consumer company is talking about, the K-shaped growth, right? Everyone at the higher end is buying a lot more, but people at the lower end are falling off the consumption radar, as a result of which there is an impact on their margins. And as all of this happens, as there is hallmarking, etc., gold is standardized across the country. So your competitive moat also decreases, and which is what Titan said as well, that they have seen increased competition, new business is coming at lower gross margins, but business is coming, and Jan was good. It was better than what they've seen on an average, which is about 20% growth. This morning we got a JP Morgan note as well saying that they expect the margins to sustain between 12 to 13% for the jewelry business, and the revenues to grow around 20%. The biggest trigger for Titan is that majority of our jewelry industry is still unorganized. They have a market share of 5 to 6%. They have a stated target of taking that market share to double going forward. So if that happens, then the jewelry business, of course, grows 2.5 times from what it was in FY22.
But this competition point that you mentioned is really important and very interesting, because you're right, there's hallmarking. One of the biggest factors working in Titan's favor was trust.
Yes.
That you wanted to go there, buy jewelry from Titan because you were getting the right diamonds, the right gold. But now I guess with hallmarking, some of that goes away.
So, in all businesses, what happens is what becomes your competitive moat suddenly becomes the industry general. So good companies, what they do is they start to look at other avenues of growth to maintain their competitive moat, right? So what started out as trust, because everyone else in the industry wasn't perhaps providing the best quality products. That became their competitive moat. And as everyone else started looking at this, they went ahead and they started looking at design, they started looking at the studded share, they started looking at online, they acquired Carrot Lane, and at the same time they are also looking at offshore opportunities, so they have export opportunities. And why just jewelry? They are looking at other
saris
areas
and
of growth
you're
as
saying
well.
bags
So
as well,
you have to constantly keep evolving, and Titan has been doing that. So that's when you look at histories of companies, right? What started out as an optionality was their jewelry business, which is now 90% of their business, right? So, in good times, you trust good companies to deliver the goods, and which is why FMCG companies trade at valuations that they do.
I was just coming to that.
I knew that.
So, okay, let's talk about this. I'm just broadening the conversation a little bit. So, typically, and a lot of you who have been in the market would know this. The moment there's a crisis, classic textbook, psychology says, go to safety. What's safety? Your toothpaste, your biscuit company, your milk company. Basically, the move to FMCG. Now, actually, I was thinking last couple of days, we didn't see that in the market all this while, right up till today. Today, we're seeing some shades of green on FMCG companies. What's your thesis on this? On FMCG is this safe haven in these times? And tell us, answer this in the context of a lot of talk around inflation and bad monsoon and El Nino. How should we look at the FMCG sector, in today's context?
So there are two parts to this. One, FMCG looked at as a safe bet. Why is that? Because the macros are always conducive for Indian consumption. 80% of our GDP is consumption driven. Secondly, all these products are bought repeatedly. These companies have no trust issues. They are cash generating. They have high ROEs. They're strong brands, and these are products which are bought regularly. And over a period of time, you've seen them establish their own competitive moats. Most importantly, from a stock market point, you are looking at your capital not being eroded, right? So flight to safety happens in FMCG mainly because over long periods of time, you've seen these stocks underperform. But underperform doesn't mean they fall. They always see time correction, rarely price correction. So your capital to that extent is protected, which is why FMCG companies are seen as safe havens. But in the current context, in the current environment, I would look at more than the margins. Everyone's talking about inflation, raw material margins, etc., and all of that and stuff. I would look at demand more than anything else. Are we seeing some sort of recovery? chances are that maybe this quarter we could see some recovery post festive season. You know, the last crop season was good, so farm incomes were higher, etc. There was some announcements made in the budget to increase you know, the farmers' incomes, etc. as well. So that could do well for this quarter. But a lot of this quarter's earnings would be plowed back into advertising to generate the kind of demand that these companies are seeking going forward. So from a 2 to 3 quarter standpoint, we're still not out of the woods. We've heard companies say that. We've heard, you know, even today, discretionary companies like Jubilant Foodworks said that people are not, while volumes of pizza that they're selling are higher, people are still looking at the lower price pizzas, 49 rupee pizzas, 29 rupee pizzas, whatever they've launched recently. And the reason for that is that you and I here look at stock market prices daily. You and I look at inflation numbers daily. So our assumption is that, okay, if inflation numbers are down last month, then that means consumption should immediately pick up.
It doesn't work that way.
The pockets don't work that way. So everything plays out with a lag. I see a 2 quarter lag at least for the way FMCG companies will see demand. And usually it's the second half of this year where you have 65% of the annual demand coming in from. There is the festive season. You have a better picture post monsoons. So time correction for the next 3 to 6 months, and thereafter perhaps if you see some sort of price upside.
And I'd also want to see how this current environment is going to impact a lot of the discretionary buying and the uptrading that you were talking about. We have so many negative headlines, stock market's not going anywhere, what is happening, economy, recession, all of that, inflation. So really need to see. I was referring to Maruti because today the Maruti management, for instance, told us that it's beginning to be felt. Of course, cars are a much higher ticket item and you need to think more and plan more before buying a car. But Maruti is actually going on record to admit that it is beginning to impact inquiries and bookings and sales.
And that's also a function of the cost of ownership of a car, right? A lot of the cars are financed in today's day and age. So if interest rates are rising, the overall cost of owning a car with the fuel prices rising, so there are a few more variables there. FMCG, you don't need finance to go buy a toothpaste, etc. But at the same time, you know, people are getting a lot more value conscious.
But the jalapeno cheese extra loaded pizzas, the top end, exactly. So, okay, before we wrap up the valuation question, they're never cheap, these stocks, are they? But right now across the sector, how do valuations look compared to, let's say, historical averages?
Historical averages?
Is there a cheap FMCG stock anywhere?
The only cheap FMCG stock is ITC, which is relatively cheap for all its, uncertainties going ahead. The other cheap FMCG stocks would be something like an Imami, something like a Bajaj Consumer, something like a Jyoti Labs. But all of those are second-rung FMCG names. If you're looking at the pedigree, high quality FMCG names, they're not coming to you for cheap, and they are unlikely to be cheap any point in the near future. Why is that? Because everyone has their own triggers. Nestle, everyone's talking about consumption staying steady, at least in the urban side of things, and them getting some more revenue coming in from their pet care business and the new products that they're launching. HUL has a change in management. Rohit Jawa takes over from June 27, so that is one of the big triggers. Godrej Consumer, you have Sudhir Sitapati who's joined in, so his strategy is playing out. Colgate, you have Prabha Narasimhan. So the biggest value created in FMCG is when there are changes in managements, and every new leader brings in their own strategy, and that strategy plays out. As far as valuations are concerned, across the board, they're about 5 to 10% below their averages. But
which is pretty big for the sector.
Which is big for the sector, but at the same time, the average has been skewed because of the big move that we saw in the last couple of years.
When 70 times starts becoming the new normal.
Exactly.
Then when you say 10% below that normal,
then you're still at 63 times. So that's how it is, but it's not 63, it's closer to around 45 to 50 times.
Sure. All right, Mangalam, thank you very much. That was a very thorough FMCG classroom with Titan as the focus, but we've got a lot of other ground covered as well. Hopefully that was useful for you, and thank you very much for your time.
We say hashtag FMCG is live. All right, thank you for tuning in.
All right, folks, we'll see you tomorrow with another episode. For now, it's back to the markets for us.